The S&P 500 closed at another record high this week. American households are, on paper, richer than they have ever been, a net worth of $184 trillion. The financial press has a word for it. Actually, it has several. A melt-up, the everything rally, animal spirits. Pick your favorite. And you, standing in the cereal aisle doing arithmetic you didn't used to have to do, feel exactly none of it. So here's the thing nobody says on the evening news. The stock market that keeps setting records isn't really a market. It's about 7 companies in a very long trench coat. Now, the usual move here is to get angry, to decide the boom is just a lie they tell about your life. Tempting, but it's a dead end. And worse, it's wrong. So let's ask a better question. Not why are stocks booming while I'm broke? The useful one, who is actually in this boom? And this is the part that'll catch you off guard. How would you even know if you were one of them? Let's read the receipts.
Start with the story we're handed, because it's a good one. Stocks are up has quietly become shorthand for the economy is strong. The index goes green, the anchors relax, whoever's in charge takes a small bow. One number becomes the scoreboard for an entire country of 340 million people. And a scoreboard is a genuinely useful thing, but only if you know which game it's keeping score of. Because the S&P 500 is not measuring the economy. It's not measuring wages or rent or whether your car insurance doubled. It's measuring one specific, surprisingly narrow game. And once you can see the shape of that game, the number stops being a verdict on your life and starts being just a number, a very loud one.
The S&P 500 holds 500 companies, but it does not weight them evenly. It's cap-weighted. Each company counts in proportion to its total market value. So the giants don't just get a seat at the table. They are the table. Everyone else is a place setting. Today, the 7 largest, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, the ones we've all agreed to call the Magnificent Seven, make up roughly a third of the entire index by weight. 7 companies out of 500, a third of the whole thing. Which means when you hear the market rose 20%, what you are mostly hearing is those 7 rose. In 2023, the year this rally was born, the Magnificent Seven gained about 76% as a group. The average stock among the other 493, about 12. Same index, same year, 2 completely different stories, and the headline only tells you one of them. There's a cleaner way to see it. Take the exact same 500 companies and weight them equally, 1 vote each. That's the equal weight S&P. It exists, you can buy it. And for most of this record-breaking rally, 23, 24, 25, that equal weight version got lapped. The headline index beat it by about 32 points, one of the widest gaps on record. It only started catching up this year. So the boom is real. It is just extraordinarily concentrated. The all-time high isn't the economy clearing its throat. It's a handful of very large companies having a very good year, standing on each other's shoulders under a trench coat with "the market" written on it in marker.
Fine. So the boom is narrow. Second receipt. Even that narrow boom is not evenly owned. Here is the number that reframes the whole picture. The wealthiest 10% of American households own roughly 90% of all stocks. The top 1% alone own about half of it. The bottom half of the country, 170 million people, hold something like 1% of the stock market between them. So when the index adds $1 trillion of value, that trillion does not fall on the country like rain. It lands overwhelmingly right back on the people who already own the most. We keep quoting market cap, the total value of the companies, as if it were a measure of how everyone's doing. It isn't. It never was. Those are 2 different quantities that happen to share a news segment. And this is the real line. Not you versus the billionaires. That framing is designed to make you feel small and do nothing. The actual line is quieter and much more fixable. Are you in this market at all, or are you watching it happen on a screen?
Third receipt, and this is the strange one. This concentration isn't just happening to you. It is, partly, powered by you. Every payday, tens of millions of American paychecks get clipped automatically, and a slice flows into retirement accounts. Most of it lands in index funds and target date funds, on autopilot, no human decision involved. That is the entire point of them. It's what makes them cheap and it's what makes them work. But follow the plumbing. An index fund doesn't ask whether Apple is a good deal this week. It buys the index, cap-weighted, which means every automatic dollar buys more of whatever is already biggest, in exact proportion to how big it already is. The bigger the big seven get, the bigger the slice of every new dollar they collect, which makes them bigger, which you can see the shape of it from here. More than half of the money in U.S. funds is now indexed. Passive crossed active years ago and never looked back. Trillions of dollars on autopilot, tilted toward the top by construction. Nobody is cheating. There's no villain hiding inside this machine. It's just a flywheel, and one of the hands pushing it, a little every 2 weeks, is yours. And before anyone yells at the flywheel, it spins in both directions. 2022, rates jumped, and the Magnificent Seven fell somewhere between hard and very hard. Several of them lost 1/3 to 2/3 of their value inside a single year. The same cap weighting that dragged the index up dragged it right back down, and the same autopilot that buys on the way up kept calmly buying the whole way down. If you had a target date fund in 2022, you lived through this. You may have just filed it under the year my statement was upsetting. Same trench coat, different weather. That's the honest version of the whole story. Concentration is not a scam, and it is not a miracle. It's a dial. It makes the ride steeper in both directions. The scoreboard didn't just get louder, it got twitchier. And you are quietly along for that ride either way, which is exactly why the next part matters.
Which brings us to the part that, for once, reads like good news. Sit down. If your gut reaction a minute ago was, well, I don't own any of this, I want you to actually check that, because there's a real chance you already do, and nobody ever told you in plain words. 62% of Americans own stock, and most of them don't own it the way the movies show it, hunched over a screen, buying and selling. They own it through a 401k, an IRA, a pension, a target date fund with a sleepy year printed in its name, like 2055, that they picked once during onboarding and never thought about again. Here's the quiet punchline. Those funds are usually built on the same cap-weighted index we've spent this whole video dissecting, which means if you have a target date fund, you already own the Magnificent Seven. NVIDIA and Apple are sitting in your retirement account right now, whether or not you could describe a single thing either company sells. You didn't miss the boom. You have just been holding a slice of it small enough to feel invisible. And people keep discovering this. Pull up a typical 401k fund menu, and most of the stock options lean on the same handful of megacaps, whatever the fund's name says. So the move is not despair. The move is legibility, actually looking, and it costs nothing. Log into your retirement account, the one you've been ignoring. Find the fund it's parked in. Then find its top 10 holdings. Every fund is required to publish them. It's 2 clicks. You will very likely see the same 7 names we've been listing, sitting near the top. That is not a stock tip. It's just the difference between knowing what you own and guessing. The gap between being in the boom and merely watching it is, for a lot of people, exactly one login they've been avoiding. While you're on that fund page, 2 more lines are worth 10 seconds each. The first is the expense ratio, the fee. On an index fund, it should look like a rounding error. If it reads like a phone bill, that's a question worth asking someone. The second is the benchmark, the index your fund actually tracks. That one line tells you which scoreboard your money is glued to, the cap-weighted one we've spent this video dissecting, or something broader. That's the whole audit. You don't need a finance degree. You need about 90 seconds and a mild willingness to squint at a PDF. Most people never spend the 90 seconds, which is how 1/3 of their retirement ended up in 7 companies without anyone ever asking them. And if you look and there is genuinely nothing there, no fund, no account, no exposure at all, that is worth knowing too. Not as a life sentence, as the single variable in this entire picture that you can actually do something about. Starting small, starting late, starting however you have to.
One quick note on who enjoys it when we all blur these numbers together. Stocks are up, therefore the economy is strong, is an extremely convenient sentence if you happen to be the person holding most of the stocks or the person who needs the scoreboard glowing green before the next election. Fusing the index and the economy in the public mind isn't a slip of the tongue. It quietly turns a narrow, top-heavy gain into a story about everyone. It's not a conspiracy. It's just useful to the specific people you keep hearing say it. So, is the stock market booming while you're broke? Kind of. The boom is real, it's narrow, and it is lopsidedly owned. But that scoreboard flashing green was never keeping score of your life in the first place. It's measuring one particular game, one you might already be playing a small hand in, and one you can finally read now that you know which number is which. The distance between the index and your checking account isn't a lie.
It's two different scoreboards that keep getting quoted as one. The good news is you can tell them apart now, and the very first thing that reveals is where you actually stand, which is the only square on the board you were ever able to move. Keep the receipts.